And with a multi-tenant building, you kind of get the best of both worlds in that you can have some occupancy to provide cash flow, maybe cover debt service, but you still have some vacancy to lease up, and that provides you some upside. What's up, guys? It's Ron from Ronald Rohde Law, and in this video we're going to talk about industrial outdoor storage. Now, if you follow this channel, you know that I love this asset class. It's everything I talk about, and it is such a great opportunity to invest. And a lot of people are kind of shying away from single tenant. If you're a new investor, you may want to look at a multi-tenant property. So in this video, I'm going to walk through underwriting, and I'm also joined by my intern, Diana, who is in the background here, and she's going to be asking me some questions because I think she understands the underwriting, she understands the real estate. So hopefully her commentary as I go through this process will show you how I underwrite a multi-tenant industrial outdoor storage property. Let's go. All right, so if you're like me, you got to get on all these lists, okay? You've got to look at deals, and one of the things that we have is this opportunity from Tag Industrial, Marcus and Millichap. This is an older deal. It is still actually for sale, but let's take a look, okay? It's in Fort Worth. That's check box number one. We like Fort Worth as a submarket. It has a huge growing population, lots of jobs, Alliance Airport. This is a great location. So, you know, right off the bat, I can see that it's got a lot of frontage. It looks like a single entrance. This is a big lot. So ignore the price tag here because for purposes of underwriting, I don't really care what the seller is asking. I'm going to come up with my own value based on what I see and I think the current property is worth in its current state, okay? 27,000 square feet of building. It's 14 acres net acreage, which means you might be buying a little bit more, but it might be in the floodplain or some of this detention pond. 100% occupied, 9 acres of iOS. They talk about upside, sure. Every investment sales broker is going to tell you about the upside. I'm skeptical. I really want to buy based on prior existing net income, but let's do what the process is for every one of these deals I get. So the first place I go is Google Maps. So here we are at Google Maps. First thing I do is zoom out a bit. You know, you can see this location. So if you're familiar with DFW, you've got these major areas of Dallas, you've got Fort Worth inside the loop. DFW Airport is kind of its own submarket, North Texas over here. But North Fort Worth is booming. I mean, I really like it as a market. It's very strong with job growth. It's a desirable place to live. They've got nice houses. And, you know, you have the airport here. Just purely a commercial airport. You've got great freeway access and just a lot of housing developments, and I think more commercial development is coming up into this area, and it really even can serve Westlake and Southlake, which Roanoke. These are fantastic pockets with great residential as well as job and schools. That's what I think drives a lot of this, but Trophy Club, Westlake, Roanoke. And so this is, you know, really its own submarket. It's not really Fort Worth. I mean, technically the address is, but when you look at it on Google Maps, you really have to understand this is your tenant market is around this area. So let's zoom in a little bit. It's on Old Denton Highway 377. It's a very popular big freeway, lots of vehicles per day. So this location is probably good with visibility. We can see that there's just this one access off of Haslett, which is not ideal. You're a little bit pigeonholed down this dead-end driveway, which is not great when you're talking about big trucks or trailers. Everybody's going to be funneling down this one road, and so it's important to understand that as kind of a limitation. Maybe this works better as a single-tenant site. Maybe I don't know what's going to happen here. This is kind of residential, but it's kind of vacant lots. It looks a little bit run down. So maybe there's an opportunity to tie into this road here. I can see these are a little bit of commercial buildings. Maybe this is the church. This looks like a temple. Oh, that's pretty cool. Look at that. It's a Thai temple. So at least it's a quasi-commercial use. Yeah, they own a lot of this land. So maybe there's opportunity to tie into here because it's commercial, although these are all residential houses here, so not the best for truck traffic if you wanted to tie in off of Sehepayak Road. Anyway, I wouldn't mess with those things. I would just take it for those limitations as, hey, single point of entry off of Keller-Haslett Road here, which is also a pretty big road. You can see that's the public storage across the way. We've got a machining company here. This property, this manufacturing, is not included in this sale. So I would assume that because they have a shared driveway here, there's going to be some type of easements. There's going to be maintenance easements. But this is what I do. This is really that initial step. So it's got a nice entrance here. They've got a fully fenced section for this tenant and their building. Keep going down this gravel road. This is a hike, you know. If I'm going down, this is a long way to go. As a tenant, it's not ideal. You know, you want to have some fairly easy access off of the roads, but there's, you know, this is probably a main thoroughfare. It looks like there's probably a lot of traffic coming in and out of this road. We keep going. This is a water detention pond, rainfall detention. That's great. CES is a great tenant. Boom. And then you get to this, 2013. You get to this gate and you can see where we reach the end of this, and it kind of opens up into this huge storage area with multi-tenant. I think if we look back at the OM, how many tenants? Doesn't say. Well, I have the marketing package, so let's pull that up. All right, so I went ahead and filled out my information for me to get endlessly spammed by Marcus and Millichap and Adam and his group, but I have the marketing OM. Let's see what information we can get from it. And just to take a pause, the high-level approach here is to find out what his current income, current net operating income. We got to see what these leases are. Are they triple net? Are they net? Are they base year? Are they gross leases? What is the current net operating income? How long is left on those leases? And what is a value that we would ascribe to that, a cap rate to that property? And then what is the market rent? Are these properties significantly below market, or are they at market plus or minus, such that there's not a real upside by turning them over? If these tenants are already paying market rent, that also makes them more willing to leave if the market slips a little bit. And then ultimately, for me as an investor, I'm always looking for value add. What could I do to this property to enhance the value? And it doesn't have to be marking to market rates immediately. I could have a plan over time to improve the property and increase the utility to the tenants such that they want to pay more. So here, this kind of clarifies here, and I think if you zoom in a little bit on this drawing, you can see that half of this common road, this concrete road, is owned up to this point. So it looks like it does include the CES electrical supply, which is a fantastic tenant. You know, they're going to be on a normal triple net lease, great rents, but maybe it's a long-term lease, and they're going to drag up the value based on this shining star here relative to everybody else. But let's see what they got. 9 acres of iOS. Okay, so there's 5 buildings, 27. I guess those flex buildings are those other 2 tenants. So if you recall from my little drop in the man, this is a building, this is a building, and this is a big building. So I'm trying to figure out how to allocate them. It's probably the biggest building here, 18,000 square feet with a high office. So anyway, let's keep digging into it. Again, ignore the offering price. So we're going to try to come up with our own number that we value this property. Cap rate is super aggressive. Pro forma, I don't really care what your pro forma is. That's their best guess. What I kind of want to look at as a basis is what's my replacement cost for the individual buildings as well as to the dirt. If you want to sell this back acreage for development, or if you want to put additional buildings, that's kind of my basis. I can't come in at $1 million an acre for outdoor storage because they're probably paying over market price for that dirt, unless market rent really is that high. So yeah, so you can see a little bit. There's 19 acres, 14 net, and 9 acres as IOS. That's important because you're going to be paying property taxes and maintaining. You're going to have to pay for the cost of maintaining 19 acres, even if you're not generating income from it. So extra land is not necessarily a good thing if it's not usable, because you're going to pay for it. Okay, so Suite A is vacant. So I guess maybe it is excluded. It's very deceiving since they seem to cover in this Elliott Electrical Supply as part of the shaded area. But that's not a 4,000 square foot building. This one in the front maybe is. It's a pretty small building, but it looks like mostly just office. So let's go back to this, because this is important. This is pretty common when you've got multi-tenant iOS trying to figure out what's going on. So this lease is expiring at the end of March, so that's coming up. You've got to figure out if they're going to be renewing. They're paying $50,000 a month. That's pretty steep, that's a big check size. Suite A is vacant, 5,000 square feet. I'm not exactly sure what that's included. So it might be this building is vacant and they're leasing this. I'm very curious about that CES because I thought flex building, front office. So we want to find out what's going on with that flex building. Flex building, 18,000. So I was right. That's the CES. But if we don't see their lease in here as a rent roll, it's not great, that North Texas Contracting is leasing 9 acres, but it looks like that's a vacant building here, and they haven't gotten a tenant in. So it looks like this guy, North Texas Contracting, leases this whole yard. So is it really just 2 tenants? Okay, market, we don't really need to know about the market, okay? Once you start looking at deals and you have something in your backyard, the market. Nobody is going to be persuaded based on a 3-mile radius of income of 15 to 24,000. Like, high income, we get it. It's just a yes or no. So that's it, right? So this is the problem. When you get this type of information, you don't have a lot of great details. You would have to call the broker, ask them what the story is on the CES building. But maybe too, we could see this CES. Yeah, City Electric Supply. Oh, maybe that's why. City Electric Supply, see locations, Gateway Alliance. That's not this location. So I think maybe they vacated because this one is not it. Or is it? No, see, they moved. I bet they moved to this location. They used to be here, but I bet they closed down because that CES in Keller is not this one. So I think that's what you're looking at. You're looking at a vacancy with this building and fully concrete, but it is probably a nice building. These pictures are a little bit vague, but these are probably the North Texas Contracting. And so let's open up a quick model and let's punch in some numbers. All right, guys, so let's pop over into the model. Diana had a question, so why don't you ask your question?
Yeah, so my question was, when you're buying a property, would you rather have a building vacant or unvacant?
Occupied.
Occupied, sorry.
Yeah, and I think that's a great question, and it really just there's pros and cons to both, and it depends on what your investment strategy is. Because if you want to instantly put a building value add, the biggest pop bang for your buck, it's buying a vacant building and then putting a tenant in. And if you have a lot of confidence in the market, you're going to be able to set the market rate based on the tenant. On the flip side, you don't have cash flow, and so it's a risk. It's called lease up risk, that you're not able to find a tenant paying market rent, what you underwrote the rent, or within the time that you underwrote to fill that. So 6 to 12 months of vacancy. On the other hand, if you're like me, I typically always look for occupied properties. I want cash flow on day one. And that's kind of a financial mitigation tool that says, look, I'm okay with under market rents for a couple of years. I would rather have cash flow on day one, build up some reserves, get to know the property, and as the lease rolls over, as long as I'm paying a good basis for the property and I'm cash flowing, I don't mind under market rents. And then when the lease rolls, then we're going to jack up the rents on the renewal. So my pop in value occurs later in time than buying a vacant building. And with a multi-tenant building, you kind of get the best of both worlds in that you can have some occupancy to provide cash flow, maybe cover debt service, cover your taxes and other expenses, but you still have some vacancy to lease up, and that provides you some upside immediately to improve value. So great question. Just depends on what you want to do. The vacant buildings and vacancy does create more risk, but cash flow on day one, typically if you have a long-term lease, you're limited in your upside, how much you can do to make money. So let's pop into this model a little bit. This one is a little bit complicated. It's from ACRE, Adventures in Commercial Real Estate. So we have a flex building and shop. I populated everything in here earlier. Let's just assume their purchase price, some of these typical closing costs. Financing costs are probably a bit more. But what I wanted to get into with you guys is debt terms. Sure, 20-year amortization. I think 6 3/4 is fine. We could probably drop that a little bit, but let's be conservative on our initial underwriting. But let's get to this income. So we have the current tenant who is leased through March. And again, these models are not perfect for iOS because they really key off of square footage. But let's kind of back into the 9 acres leasable, approximately 400,000 square feet. And then we have, call it for that 18,000 square foot building, the flex guy. So this is the flex vacancy. We're not stabilized, and stabilized. I think market rent for that building, might be $12 a foot. But that's only to the building. So that's why this number probably should be 18,000. Yeah, so I'm okay with that. Oh, they're not paying $8 a foot. They're paying, what was their gross rent per year? So I just wanted to back into $594. So even less than that, 1.7. All right, so that's pretty close to, current, and what our upside is. It's really only adding about $200,000 a year, but that's pretty significant. We don't know what the lease structures are, so we can kind of assume it's triple net. Not really sure where we're going to be on property taxes. I would look those up. You can look at the county assessor. You can see exactly how much property taxes were last year. Insurance is just, I peg it at usually about 80% of what the property taxes are. So something like that. So yeah, we have gross rent minus expenses, a little bit of capital reserves. Market cap rate today probably should be closer to that. Maybe you can exit for a similar cap rate. So here you get to, a value of 6.6. And so roughly on an in-place 6.25, yeah, you really can't pay too much for this, because if you're buying at like a 7, you can really only pay about 6 million, 5.9 for this property. And then if it stabilizes to a 7.5 cap, the building's only worth 8.2 once it's leased out. With some rent growth and further appreciation, you can probably exit at 10 million. But that's not a whole lot of gain if you're considering putting down 25, 30% on a deal like this. You're not quite hitting a double equity multiple. So here, 1.65 exactly. You're not hitting a double equity multiple. Your IRR is in the low teens. It's not a great deal to buy this thing. You can't buy it at 8 million. And so I would put in an offer closer to, call it 5.5, just based on the short-term nature of that tenant who is rolling and whether they're going to renew. You basically are going to put money down to get a conversation with the tenant. You want to look at the leases. You want to see what their marketing looks like for that other building. What are some ways you could add value if that big tenant, the North Texas Contracting, doesn't renew and you have a 100% vacant property? You're going to be burning $50,000 a month on this thing while it's vacant, and so you've got to have a plan to lease it. And if we pop back over to the aerial, I'll show you kind of my initial thoughts. Is this is a great site already. You would have to build some more buildings back here and make it a functional space, separate space. And maybe I would do it back here. Your property line runs all the way out here, but this stuff hasn't been gravelled. And I really think the only opportunity is if that North Texas Contracting didn't renew, you would have to expand this out. And I would consider putting a building back here on this edge and making this a separate IOS with a building, bathroom, offices, everything. And that's a big lift. That is a very complex project to do while you don't have cash flow on the front half of your parcel. But look, everything that's here, I guess this is kind of a creek though. This is waterways. This may not be opportunity for extra storage. Yeah, okay, you can't really tell here, but yeah, this road is rough. Well, let's peek through the trees a little bit. Maybe, but you might have a little bit of square footage to improve this boundary and pop out the extension and just get more square footage of storage, especially if you put another building here, then that would be an attractive site. This is a big project. It's not easy to do, and I hope this was helpful to just kind of show you how we would value this property, as well as the steps for digging into marketing materials and what's available online. So thanks for watching, and we'll see you next time.